Hello. We are going to do a quick uh, uh, voiceover PowerPoint of Module 5. Couple announcements. Homework on accounts receivable is due also on December 21st before noon. The midterm exam, you'll remember, is also due before noon on December 21st. Both of which can be turned in to me via email at susan.crossan@emory.edu. Just be sure to label your file and email, in the email subject, put your name. So when you name your file and when you send your email, put your name in the subject area or the name of the file so I know whose is whose. For the exam, remember to show your work on the exam and then send me a scanned copy of that exam and all your work. Or you can do it in Excel or in Word. Just be sure to label your work by question so I can follow what goes with which. Remember to return not only these documents showing your work, but also the completed answer sheet. And that answer sheet is what I will grade to begin with for the answers to your questions. Don't make me hunt. All of this is due to me, again, before noon on December 21st, and no late work will be accepted, so if life happens to you, get it done early. Also for the homework, we'll go over it at the very end of today. Next slide. Today we're going to talk about what do you need to think about as far as cash, what do you do with sales with discounts, there's two different methods, what do you do with sales returns, how is that tracked, financial statement disclosures for cash and accounts receivable, then number 5, this is the crux of it, is what do we do with bad debts, whether we're using the cash basis or accrual basis, what are those journal entries, what do the T accounts look like, and this is where your homework focus is, and finally, what is the impact of these entries on the financial ratios. You'll remember that when we talk about the operating cycle, that's also known as cash to cash, and you start out with cash and you manufacture or purchase inventory, and we'll talk about those entries and tracking inventory in the next module or chapter. Then we make a sale. So we're going to talk today about sales, debiting accounts receivable, crediting sales, and how do you figure out how much that journal entry should be for. Once you make that sale, there are two accounts that come into play, accounts receivable, where you track your credit sales, and its shadow account, or its contra account, allowance for bad debts, also known as allowance for doubtful accounts, allowance for uncollectible accounts. It can also be called provision for bad debts or provision for uncollectible accounts or doubtful accounts. So those are the two current asset accounts that we use to track what we're doing with our customers. Finally, our customers pay, debiting cash, crediting accounts receivable, and we're back to our cash again. So that's kind of the overview of the operating cycle and what we're going to be talking about. Now, when you think about cash, there's certain restrictions that may be placed on cash when you borrow money, and those are called loan or debt covenants. Sometimes you have to keep compensating balances, like 20% of the loan amount in the bank at all times. If you do, you generally get a lower interest rate. You might also need to track your cash and its accounting records in two different places. For example, the bank keeps a record of your cash account, and you need to reconcile that periodically with your record of what's in your cash. When we also think about cash, there's the physical controls. making sure that there's 1 to 2 signatures on checks, make sure the cash payment is authorized, that when you have petty cash, that it is also tracked with appropriate receipts. So if you have money, you track it. Accounts receivable. Well, the definition of an account receivable is it arises when you sell goods or services to customers, and usually you say that you sell to them on account. They're recorded at the face amount, but when we show them on our balance sheet, we show them at their net realizable value, which is also called carrying value or the book value. That's the amount of cash you really think you're going to get out of your receivables. And the reason you don't always get the cash that you think you're going to is, well, there might be some discounts extended to that customer if they pay early, and those are called sales discounts or cash discounts. There may be returns from the customer, or you may give the customer certain allowances. All of these three are contra revenue accounts because we do want to track what makes our revenue go down, and so those are deducted out when we come up with the amount called net sales, or the amount of sales that stuck with those customers. Another reason for lack of collection is the customer may not pay, and those are called uncollectible accounts receivable, doubtful accounts, or just plain old bad debts. So those are other reasons. Now, cash or sales discounts. To encourage customers to pay early, especially if they're commercial accounts, we may extend to them credit terms. And those would be things like 2, 10, and 30, where the customer would get a 2% discount if they pay within 10 days of the invoice, but the whole bill is due within 30 days of the invoice. Or it may say 210 EOM. That means you get a 2% discount if you pay within 10 days of invoice, but the whole bill is due by the end of the month. Now there's two ways of handling these. One is called the gross method, where you assume nobody's going to take the discounts that you extend. And the other method is the net method, where you assume all customers are going to take the discount. So let's take a look at those. All right, here's an exercise. In this case, we're going to assume the gross method. So on May 1st, when we sold Maine lobsters at a gross price of $30,000, we debit accounts receivable and credit sales for $30,000. On the 5th, when we make another sale for $20,000, again, we'll debit accounts receivable and credit sales. Now, that first sale that we made gets paid on May 6th, which is within the 10 days of the sale. So they're going to get a 3% discount, meaning they only have to pay 97% of $30,000 in cash. So thus, on May 6th, we'll debit cash for $29,100, or 97% of $30,000. We'll debit sales discount, a contra revenue account, for the 3%, or $900, and we'll credit accounts receivable for 100% because we need it to get that $30,000 off of our books. But contrast that with the May 5th sale, where the customer did not pay within the discount period, and then there is no sales discount account. It's just simply debit cash, $20,000, and credit accounts receivable because they paid after the 10 days, but within the 30 days that it was due. Contrast this with the net method. Under the net method, we assume everybody's going to take the discount because 3% off is such a great deal. So on May 1st, when we make the first sale for $30,000, we'll debit accounts receivable only for 97% of that amount, or $29,100, and credit sales for $29,100. And we do that because we assume that everybody's going to pay within the 10 days of invoice. On the 5th, when we make another sale for $20,000, notice again we report it only at 97% of $20,000 or $19,400. Since we pay within the discount, or the customers pay within the discount period on May 6th, it's simply debit cash $29,100, credit accounts receivable. But notice that the sale on May 5th, since it was paid after the discount period, will receive cash of $20,000. Well, we'll debit cash for $20,000. The credit to accounts receivable, remember, is only for 97% or $19,400. So we need another credit, which is going to be a revenue account called cash discount loss for $600, or that 3%. The reason it's a revenue account is because it's not the sale, it's because the customer failed to use the credit terms. So thus we have a different kind of revenue stream, which is from customers not taking the discounts extended. So that's why it's called cash discount lost or sales discount lost, and it's a revenue account as far as we're concerned. I'm going to give you an additional example so you can take a look at this on your own using the gross versus the net method of recording the following transactions. So enjoy this one. Well, what if somebody returns something to us? Well, if a customer returns, that means that we're going to use a contra revenue account called sales returns and allowances, and we'll credit accounts receivable because they no longer owe us the money because they returned the item. So sales returns and allowances is a contra account. Notice that when we compute net sales, or the actual sales that happened, we'll take the gross sales amount from the sales account less the balances, those debit balances in the sales returns and allowances account and the sales discount account to come up with net sales. All right, financial statement disclosures. When we talk about sales, footnotes to the financials have to tell you when do they recognize the revenue and do they make any estimates or provisions or allowances, so provision and allowance mean the same thing, for returns, for rebates, for those discounts, and they have to tell you, if they do, how they set up those estimates for returns, rebates, or discounts. So I've shown you here Eli Lilly, and I've also shown you Nike as far as the footnote disclosures that they have in their financial statements about revenue. When we look at accounts receivable on the financial statements, accounts receivable shows up on the balance sheet, and notice that I'm comparing what we're showing for Walmart versus Eli Lilly. Because Walmart only shows receivables net, they must show a footnote that shows, what do you mean, what is net? So how did they compute receivables net? Whereas Eli Lilly shows accounts receivable net of the allowance, that estimate for bad debts. So it doesn't have to have the footnote disclosure. They do have to have footnote disclosure for other kinds of receivables. So notice other receivables is note 10. The thing that you'll see on an income statement when we talk about financial statements and accounts receivables is an account called bad debt expense. And that's an estimate of the accounts receivables or sales that we think will not pay us in the future. We don't know exactly who won't pay us, because if we did, we would not sell to them on credit. So we have to kind of estimate it in the year of sale. And we do that because we want to match all of our expenses with the revenue for the period. And so we're now going to start talking about bad debts and how we estimate them. Notice the Walmart footnote here shows how do we figure out what our receivables are. Notice they're stated at their carrying value, net of a reserve for doubtful accounts. And that reserve or provision is an estimate of customers who will not pay us. And we come up with this estimate in two different ways, and we'll talk about how we do that in a second. So here's just 3 examples of accounts receivable disclosures. Well, for Coca-Cola, they were a little bit more telling in their footnote disclosures. So we can look at their trade receivables, and we can kind of figure out why the accounts receivable for Coca-Cola changed between the beginning and the end of the year. And I've jotted down for you here the anatomy of the T account. So notice accounts receivable are increased by credit sales. They're also increased when a customer who you've previously written off pays you. Also, accounts receivable are decreased when cash is collected from customers or you write off specific accounts. In the Coca-Cola's footnote about trade receivables, it also tells you the anatomy of the allowance for doubtful accounts or the allowance for bad debt account. And notice that this is the, again, contra accounts receivable or a contra current asset account. So it will have a credit beginning balance. It's credited for the amount of the estimate or the adjusting entry. It's reduced or debited by when you have write-offs of specific accounts or other things that might happen. So this is just a crosswalk between what do T accounts look like and what do the footnotes look like. When we look at the cash flow statement, you can either show the impact on receivables net, like it is here for Eli Lilly, and we can see that our receivables increased, which we know from a cash flow statement means that I'm going to deduct it because my cash decreased. So that's one way, just showing it net of the accounts receivable and its allowance account. Or you can show both sides of it, where here they show you the provision for doubtful accounts, the allowance account, and they also show you the change in your accounts receivable and how it impacts the cash flow statement. All right, so let's get down to the specifics of it. And I just want to mention this, but this is not where we're going to focus. This is if you are a cash basis company, which is not where we spend most of our time, or if we're doing our tax returns. So for the tax return purposes, there is no estimate of adjusting entries at the end of the year to estimate bad debts. We only make entries when we know the customer's name who is not going to pay us, and we do a write-off entry, which is debit bad debt expense, credit accounts receivable, I know your name, for the actual amount. Now, if that customer comes back later and pays us some cash, that's called a recovery, and we have to put them back on our books by debiting accounts receivable, I know your name, crediting bad debt expense, and then number 2, debiting cash and crediting accounts receivable for the amount of cash we receive. Now you're saying, why can't I just debit cash and credit bad debt expense? Well, you could, but you wouldn't then be able to track who paid you after you had previously written them off. So you have to put them back on your books before you take their money. So this is just an FYI. Where we're going to spend most of our time is under the accrual basis. And this slide compares and contrasts the cash basis, which is also called specific write-off method, and that's up in the corner, or the accrual basis, which is what our focus is, which says at the end of every year, because we have accounts receivable, because we have credit sales, we need to estimate an amount of those based on our experience that we don't think is going to pay us in the future, and make an adjusting entry. And that's those expense it now entries where I'm going to debit bad debt expense for this estimate and credit an contra current asset account called allowance for bad debts, allowance for uncollectible accounts, allowance for doubtful accounts, provision for bad debts, provision for uncollectible accounts, or provision for doubtful accounts. And the two methods that you can use that we will focus on are starred. One is called the percentage of sales method, which we'll go through first. The second is called the aging of accounts receivable method, which we'll go through second. There is a choice. You don't do both. It's one or the other. There's a third method listed up here, percentage of accounts receivable method, which is like the aging method, and we just will not cover it. All right, so what are the entries at the end of the year? Well, the entry to record my bad debt expense is always, regardless of the method, debit bad debt expense, credit allowance for bad debts, uncollectible accounts, or doubtful accounts. The amount is an estimate. To write off a specific account, meaning I know that customer is not going to pay me, notice I write it off against this allowance, this estimate, by debiting the allowance and crediting accounts receivable I know your name. So to recap, up there I have a T account called allow, or which is short for allowance for doubtful accounts, uncollectible accounts, or bad debts. Notice it's a contra current asset account. It has a beginning credit balance. It's increased by the adjusting entry, which is the estimate. It's reduced when we write off specific accounts, and we always have a credit balance at the end of the period in that allowance account. And in blue here I have my country western song. I wrote them off my books, but they're still a black spot in my heart, because once you write off an account, they no longer exist in your accounting records. So if they pay you and you have a recovery, you have to put them back on your books by debiting accounts receivable and crediting the allowance, and then secondly, taking the money, debit cash, credit accounts receivable. What's in between there with the big circle around it is the direct write-off method, which would be the entry you would make if you were under the cash basis. So that's just there for information. So to recap, when we look at our accounts, this is everything that can possibly happen in them. The allowance account, remember, is a contra current asset account. It'll have a beginning credit balance. If there's any recoveries, it is also a credit. The adjusting journal entry for the estimate is also a credit, and the only time you debit the allowance account is when you write off particular accounts. At the end of every year, there's going to be an account on the income statement that's called bad debt expense, doubtful accounts expense, or allowance for or uncollectible accounts expense, and that will show the estimate of the bad debts for the year that pertain to this year's receivables or sales amount. We know also about accounts receivable, which is on the balance sheet. It's a current asset increased by debits, so it'll have a beginning and ending debit balance. It's increased by credit sales. It's also increased when we recover an account. In other words, a bad customer comes through with cash. And it's reduced when customers pay cash or when we write off particular accounts. The star here is about the different methods, and it's just a prompt to say the aging method, which we're going to talk about second, gives you the ending balance in the allowance account, whereas the percentage of sales method gives you the amount of the expense, and then you have to compute the ending balance. So I don't want to get you confused yet. Here we go. This is of information to you just to say for Emerson Electric, which is a company out of St. Louis, for these years, they just wanted to see if the amount of the allowance for uncollectible accounts as a percentage of receivables went up or down, and it went up, which meant that the receivables were getting a little dicier, and that made sense because this was between 2008 and 2009. The market and the world crashed, and so yes, the estimate for bad debt should go up. Part B, bad debt expense on the income statement is not 93, and the reason is the estimate for bad debts is the difference between that beginning and ending allowance account balance, because for this year the estimate is 3 based on this year's either receivables or net sales, and we'd have to look at the footnote to figure out exactly what. All right, so what are we going to look at first? Percentage of sales method. Second, we're going to look at the aging method, and the thing to remember here is that net accounts receivable is at its net realizable value, also known as its carrying value or its book value, and it's our estimate of how much cash we really think we'll be able to harvest from customers paying their accounts. It's not fact, it's our best guess. So, other things to know about. Notice that these bad debt, doubtful account, or uncollectible accounts are estimates. We don't know when they'll go bad. We just know a certain amount of them will go bad. So thus, we've got to estimate them in the year of sale. We do this either based on percentage of sales method, which is really simple to do, or the aging method, which is more accurate. For international financial reporting standards, they use comparable methods to these. All right, percentage of sales method, option 1. To get the bad debt expense for the year, that adjusting entry where we debit bad debt expense and credit the allowance for uncollectible accounts is just to take the amount of the sales times a given percentage, and that is the bad debt expense. This is called the income statement approach because notice the estimate is based upon an income statement item called revenue. After making that adjusting journal entry, we then have to figure out what the ending balance is in the allowance account. So, for example, in P64, it says that 3% of net sales will be proven to be uncollectible. So that's our estimate that 3% of sales are going to go bad. So in 2014, to prepare in Part A the necessary adjusting entry to record the estimated bad debt expense, we know the entry is debit bad debt expense, credit the allowance for bad debts or uncollectible accounts or doubtful accounts, and all we have to do is take 3% of net sales. So that's gross sales minus sales discounts minus sales returns. So the net sales for 2014 is $1,650,000. So 3% of $1,650,000 is $49,500. So in Part A, the adjusting entry will be for $49,500, the estimate of 3% of net sales. In Part B, it wants to know what the ending balance is, and we see that the beginning balance in Part B was $65,000, that $70,000 was written off during the year, and the write-off entry is debit the allowance for bad debts, $70,000, credit accounts receivable, I know your name and I don't like you, $70,000, which reduces the allowance account. We know we made the adjusting entry for $49,500 to the allowance account, so the balance at the end of 2014 is $44,500. The beginning balance plus the adjusting entry minus the write-offs. When we go into 2015, again, we need to make the adjusting entry at the end of the year based on 3% of net sales, and net sales in 2015 is $1,350,000, the gross sales minus the discounts minus the returns. So our 3% is $40,500. So in Part C, we'll debit bad debt expense, credit the allowance for bad debts for $40,500, or 3% of the net sales. When we do Part D, they again want to know what the ending balance is. We know the beginning balance is $44,500 because that was the ending balance at the end of 2014. It tells me that we wrote off $85,000, meaning during the year we debited the allowance for bad debts and we credited accounts receivable for $85,000. We also remember we made that adjusting entry, so oh my goodness, look, the ending balance in the allowance for bad debts is zero. This is way too low. I would say that they need to revise their 3% of net sales estimate up a bit because there's certainly no allowance or reserve or provision for bad debts for this year's sales. So, yeah, they need to rethink that. All right, here's another one. It's telling me a bunch of information, and it's asking me to analyze the activity in the allowance for doubtful accounts account and to comment on the bad debt estimate as whether it was sufficient or not. So, if I think about what is given to me, gross sales, I know increases accounts receivable. So I'm going to start in 2011. I know that this was a brand new company, so my beginning balances and my allowance and my accounts receivable accounts at the beginning of 2011 is zero. It's going to be increased in 2011, accounts receivable is, by my credit sales of $1.5 million. The other things that happened in 2011 is I see that my accounts receivable ending balance is going to be $650,000, and I know the only things that make my accounts receivable go down is if customers pay me cash or if I write them off. And the third item says we wrote off $10,000 in 2011, so I can back into that my customers paid me $840,000 in cash in 2011 as a result of those credit sales. When I move into 2012 for accounts receivable, my 2011 ending balance is $650,000 becomes the beginning balance. It's increased by the credit sales, gross sales in 2012 of $1.4 million. It tells me my ending balance in 2012 is $600,000. And again, I know there's only two things that can make accounts receivable go down, and that's the customers paying cash, which we can't find yet, and the amount of receivables that were written off. I see the actual bad debt write-offs were $22,000 in 2012, so I can back into the customers paying me cash of $1,428,000. If I look at my allowance account, starting in 2011, I know I start with a zero balance. I know I wrote off $10,000 So that shows up as a debit. And so now I need to figure out what my adjusting journal entry is. And I know that's going to be debit bad debt expense, credit the allowance, and it's going to be 2% of gross sales. Well, gross sales in 2011 were 1.5 million, so 2% of 1.5 million is 30,000. Since I wrote off 10,000, my ending balance in the allowance account for 2011 is $20,000. In 2012, I wrote off 22,000, so that'll show up as the debit. I need to figure out what my adjusting journal entry is, and it's going to be 2% of gross sales. Gross sales in 2012 were 1.4 million, so that would be 2% of 1.4 million is 28,000. So the beginning balance of 20 plus 28,000 minus the write-offs of 22 gives me the ending balance for the year of 26,000. So it's kind of like CSI accounting, isn't it? This is for your information kind of thing. It's again about bad debts over time and making those entries to write off and making those entries to make the adjusting journal entry. And the adjusting journal entry is 3% of credit sales. So if I know what credit sales are in 2013, 14, and 15, I can figure out what that adjusting journal entry is. And notice in this case, I've made the journal entries and my allowance account is shrinking as far as its ending balance, and so 3% probably is not enough to cover what's really happening. And that's what this is saying. It's in Part C, comment on the sufficiency. It's way too small. The aging method. Under the aging method, it's more commonly used. Those footnotes we looked at all use the aging method because it is more accurate. So what you do with the aging method is you take your accounts receivable balance, and in this case, you stratify it by when did you hear from the customer last. So are the accounts current? And in this case, 290,000 of your accounts receivable are current, meaning the customer has paid or the sale has taken place within the last 30 days. Or is it past due? Is it 1 to 45 days past due, 46 to 90 days past due, or over 90 days past due? So you stratify the total balance in your accounts receivable. The percentages of non-collectability comes from your experience, and these percentages will always be given. What you do is you take the non-collection probability times the strata, and you come up with the estimate of what you think is not going to pay from that strata. After you have figured all those out, you total them up, and in this case, 22,740 is our best estimate based on an aging of the accounts receivable of what's not going to be collected. Now here's the difference. This aging gives you the ending balance in the allowance account. So that's the EB, the old ending balance. So what you have to do then is look at what else is in the allowance account to compute what the adjusting entry has to be in order to achieve that desired ending balance of 22,740. So let's take another example. This looks a little messy, but it's really not too bad. So in that dense paragraph up above, it tells me about accounts receivable. That accounts receivable has a beginning balance of $90,430. That during the year we had credit sales of $475,000. That there were returns of $6,200. That we wrote off $8,800. And that customers paid us cash of $452,730. So our ending balance in our accounts receivable at the end of the year is $97,700. Now, up until now, they have aged most of the accounts except for those accounts in black that are listed there to be Smith, L. Wing, A. Rack, T. Cat, M. Nutt, S. Prince, and J. Wind that come to $8,060. So what we need to do, should you accept the challenge, is to take that $8,060 with the other aging that's already been done, $89,640, and notice we come to the ending balance of $97,700. So all of our receivables are accounted for. It's just some of which have already been aged, and some they want you to have the experience of aging accounts. All right, so this problem takes place in December. So if they're not yet due, that means they're due in the month of January. If they're 1 to 30 days past due, they were due in the month of December. If they're 31 to 60 days past due, that means they were due in the month of November. If they're 61 to 90 days past due, that means they were due in the month of October. And if they're over 90 days past due, that means they were due in September or earlier. So when I look at B. Smith, it's due next January, so it's current. So I put the $930 under the column not yet due. When I look at L. Wing, it's due December 24th, so it's in the 1 to 30 days past due, and that's why you'll see the $645 under the December column. When I look at A. Rack, it was due on September 28th, so that $1,850 goes under the over 90 days past due, or the September column. When I look at T. Cat, well, that was due in August, so that's over 90 days past due, and that's why you see the $2,205 in the over 90 days past due column. When I look at M. Nutt, it's due in December, so that's 1 to 30 days past due, and that's why you see the $350 under the December column. And S. Prince is due next year in January, so it's not yet due, so that's why you see the $1,785 in the January column. And J. Wind for $295 was due in November, so it goes in the November column. I then total up those columns, and I see that January comes to $51,745, or not yet due. I then look down at the percentage considered uncollectible, and I see it's 2%. So I'm going to take 2% of $51,745, and my estimate based on that strata is $1,034.90. For December, $25,105. So $25,105 times 5% uncollectability estimate comes to $1,255.25. November came to $95.05. I'm going to multiply that by a 15% uncollectability estimate, which is $1,425.75. As far as October, that's $3,990 times the 25% estimate of uncollectability comes to $997.50, and the over 90 days past due, or $7,355, I'm going to multiply by the uncollectible estimate of 50%, which is $36.77.50. Then I will total up all of those estimates, and it comes to $8,390.90. That will be the ending balance in the allowance account. Notice that in that dense print up there, it tells me the beginning balance in the allowance account was $8,100, and that we wrote off $8,800. So by process of elimination, I can see that my adjusting journal entry needs to be for the difference. or $9,090.90. So the entry will be debit bad debt expense, credit the allowance account for $9,090.90, and by making that entry and putting it in the allowance account, we will come up with our desired ending balance, that the best estimate we know based on the aging of accounts receivable of $83.90.90. So I'm sorry that's a little messy, but it's best to do it all in one place. So under the requirements, complete the aging of the accounts receivable. Well, we know that came to $83.90.90. We figured out the ending balances in the accounts receivable and the allowance account by doing T accounts. And we figured out that the amount of the adjusting entry needed to be $90,090.90. And what role do estimates play in the aging analysis? They play a big part because notice we're coming up with a lot more percentage estimates based upon the age of when have I heard from this customer last. Things that impact that is how is the economy going, industry norms, or the geography of where the company is located. So this is another one. This is just an FYI. Again, you can see there's lots of information here, and they want you to figure out what the adjusting journal entry is, which is always debit bad debt expense, credit the allowance, what the ending balances are in the allowance account, and why is it different between the aging method and the percentage of sales method. So here is the recap of this. So again, you can compare and contrast percentage of net sales method, where it says 1.5% of sales is going to be uncollected, and you have to compute the ending balance, versus the aging of the accounts receivable method, where you age your accounts, find the ending balance in the allowance account, and then back into what does the adjusting journal entry need to be. So 2 different methods. All right, so what do we do if we write off an account? Well, in this case, we sell to Irma Hegerman, $7,200 on account, and she paid us $2,400, and then we had to write off the rest. So these T accounts recap what we saw going on with Irma as far as making the sale, and you'll see down below we sell, it's debit accounts receivable $7,200, credit sales $7,200, which makes our current assets go up. When we collect cash from Irma Hegerman, cash debited for $2,400, credit accounts receivable $2,400, current assets go up, current assets go down, so there is no change in current assets. And when we write off a particular account for Irma, notice we debit allowance for bad debts, uncollectible accounts, or doubtful accounts, $4,800, the difference, and credit accounts receivable, Irma Hegerman, $4,800. When we write off, our current assets go up, our current assets go down, so there's no change in our current assets. Notice also there's no change in the accounts receivable account balance when there is a write-off. So sometimes that's a trick question. You know, how is that going to impact the ratios when you write off? It doesn't. What is the balance in accounts receivable before and after write-off? It's exactly the same. So just be aware. All right. This one is one of those CSI accounting where we're given beginning and ending balances to our accounts receivable and to our allowance accounts, and they ask you to find out the differences and what actually happened. And so this is informational for your benefit. All right, here's one where for Hadley's first year of operations, they've come up with this great income statement where they're making a profit of $33,000, and this great balance sheet where their total assets are $130,000. The problem is one of their sales is for $50,000 to a customer of questionable financial health. So if they include that $50,000 in the balance sheet and the income statement, these are the results. But if any reasonable person knew of that $50,000 of their receivables was to a sketchy customer, they probably would make different decisions based upon this company, or based about this company. So what our mission is to recast the income statement and the balance sheet, backing out the $50,000 by making the adjusting entry at the end of the year for our estimate of bad debts. And remember that adjusting entry is bad debt expense, $50,000, credit allowance for $50,000. If we make that entry, then on our income statement, we will now have a bad debt expense, which increases our expenses by $50,000 to $115,000, which means that our net income converts into a net loss of $17,000. Well, what does that do to the balance sheet? Well, our net accounts receivable now would be reduced by $50,000 to $35,000, so our total assets are reduced by $50,000 to $80,000, and our net income, because it now becomes a net loss of $17,000, makes shareholders' equity become a negative $13,000. So total liabilities and shareholders' equity, a negative shareholders' equity, also comes to $80,000. Very different results. So, questions? Part A, how does that impact the income statement? There's now a net loss of $17,000. Why would auditors probably make Hadley choose the more conservative reporting? Because of the materiality of the amount. It's a big number on the first year of this company's history. And Part C, if the CFO says, oh no, there is no bad debt, because of the matching principle where we match against our revenues for the year all possible expenses, we would make that adjusting entry for $50,000 for our estimated bad debts. So that's why it will happen. All right, we're almost done. The entries we've talked about is sales on account. Accounts receivable goes up, current assets go up, credit sales, revenue goes up. So if I was looking at my liquidity ratios and my current assets go up, that means the ratio would go up. For cash collections, for accounts receivable write-offs and accounts receivable recoveries, the ratio, the liquidity ratios do not change because current assets go up and they're mirrored by other current assets going down. So remember this, cash collections, accounts receivable write-offs, and accounts receivable recoveries do not impact the liquidity ratios. The bad debt adjustment at the end of the year does, because we debit bad debt expense, so our expenses go up, and we credit allowance, which means our current assets go down, so our liquidity ratios would go down as a result of that adjusting entry. All right, your homework. Your homework, Part A and Part B is based on the percentage of sales method, and Part C, D, and E is based on the aging. So where you start is you'll start with 2015, and everything in 2015 is based on a percentage of net sales. So make sure you compute net sales. 2016 is based on the aging method of accounts receivable. So what you need to do is start with 2015, and in Part A it says, what is the adjusting entry to record the provision for bad debts under the percentage of net sales method? Well, you know, the adjusting entry is always debit bad debt expense, credit the allowance for doubtful accounts, uncollectible accounts, or bad debts. All you have to do is figure out what the percentage of net credit sales is. So it says in the on the second line there, 0.5% of annual net credit sales for 2015. So once you figure out what that amount is, can you complete Part A? Yes. Part B says, do T accounts for accounts receivable and the allowance for bad debts, and show all the things that are happening in 2015 in the accounts receivable and the allowance accounts, including that adjusting entry you just made. The world then turns to 2016, and you'll have to do an aging of your accounts receivable for 2016 based on those percentages that are given to you at the top for the aging. And you also know what your accounts receivable aging is, because down at the bottom it says days past the accounts receivable invoice date as of 12/31 for 2016. Notice you've got those stratas there. So you'll age those accounts. So that's the first one. That's Part C. Part D says, prepare an analysis of the T accounts. So again, show me everything that happened in accounts receivable and the allowance account in 2016. And Part E, what is that adjusting journal entry based on the aging method? And we know the entry is debit bad debt expense, credit the allowance for bad debts. You just have to back into what the aging amount is. So that's it for today. I hope you have found this useful, and if so, I hope it helps. So thank you so much for listening, and I'm going to stop recording now.